afternoon. It's actually a nice afternoon here today. And the last time I looked at the market, it was just about doing nothing. It's been up and down today. We have a number of down days here. I think the Dow is below 15,000 now. And at its high, it was well above. Now, today we're going to continue on with CAPM and factor models. Now, first, let me give you an excellent reference on the history of hedge funds. The history of hedge funds. It's a book by Sebastian Malley, and the title is More Money Than God, Hedge Funds and the Making of a New Elite. I think you can probably pick that up on Amazon or books.com, a used copy. We're also going to do something. It may already be up. I'll check with Shawnuk. That we have a nice list of useful websites that was taken out of a previous edition of Bodie, Kane, and Marcus. So those may be very useful for your project. I think at least one person took the history of hedge funds. Another good topic could be the various hedge fund strategies. Now, now where we left off is that we outlined the text derivation of the CAPM equation. Of course, the CAPM equation is that RI, the expected rate of return of asset I, minus the risk-free rate, is a function of beta I times the expected rate of return of the market portfolio minus the risk-free rate. Okay. So the text derivation of this was a little tricky. Let's give a simple derivation. Okay. And we'll start off with a lemma. A lemma is just a result that's used to prove another result. We'll say that the expected rate of return of an asset I is a linear function of the asset's beta I. Okay. Now this is critical to our proof. So let's look at an outline of the proof of this. Let's consider a portfolio of simply two assets, asset 1 and asset 2. Then we have that portfolio's beta is just the weighted sum of the betas in the portfolio. It's a beta 2. W1 beta 1 plus 1 minus W1 beta 2. We'll call that equation 1. And equation 2 will say that we know that the expected rate of return of the portfolio is nothing more than a weighted sum of the expected rate of returns of the two assets in the portfolio. So it's W1 R bar 1 plus 1 minus W1 R bar 2. And we'll call this equation 2. Okay. Then I say simply substitute equation 1 into equation 2 and solve. And that should give you the result. I put simply in quotes because it's not so simple here. Okay, now let's consider the following figure. Let's plot the expected rate of return versus beta now. So this is a little different than we had done here. And let's take a point here, RF, our risk-free rate of return. And let's go out here. And let's take a point here, R bar M. That's the market expected rate of return. So this is a point M. And the beta corresponding to the market is just 1.0. 0 here and 1.0 there. So if you have a beta of 1.0, you move exactly like the market. And this, when we plot R bar versus beta, now this line here is called the security market line. Remember, we're plotting versus beta, whereas before we would plot it versus sigma. Okay. Now, what happens when let's make sure we gave that here. Let's go back here. We should have stated the following. We should have stated that R bar I equals A plus beta IB. Okay. So that's a linear function of beta I. It has an intercept A and another thing B here. Okay, so let's look at this. When beta I equals 0 here, we get Ri equals Rf. Okay, because here's beta I equals 0 here. So in that case, we just get Rf here. So let's plug this into our linear equation. So we get Rf, oh, we don't need the bar. Rf equals what? A plus 0, this is our beta I, B, equals A. So we know in our equation, our linear equation, A must equal Rf, the risk-free rate of return. Okay. Now, let's take another one here. Let's take beta I equal 1. At beta I equal 1, what do we know? We know that we're right at the market portfolio here. So we get R bar M equals A plus 1 times beta here. Or rearranging this, we get, this should be B. Sorry, because 1 is our beta I. Okay. Or we get the following, we get B equals R bar M, the expected rate of return of the market portfolio, minus A. And we know that, A equals the risk-free rate of return. Let's call this 1. Let's call this 1 prime here. And let's call this guy 2 prime, just to distinguish the 1 and 2 from the 1 and 2 that we used to prove the lemma. Okay. And now we substitute one prime into 2 prime. Equation 2 prime, and we get, when we say substituting 1 prime into 2 prime, yields the following. Yields that R bar I equals RF plus beta I R bar M minus RF. Or R bar I minus RF equals beta I times R bar M minus RF. So the risk premium of any asset I is related to the risk premium of the market portfolio by our beta here. So all we have to know is these betas. It makes life a lot easier for us. Okay, we did that. The book's proof of that CAPM equation is a little trickier. And I wouldn't expect you to memorize that. Now, let's look at the CAPM as a pricing formula. The CAPM equation we gave just gives us the expected rate of return on an asset, but it doesn't tell us what that asset's price should be. So it would be nice if we could do something about the price. Okay. So let's look at a risky asset. Examine a risky asset that is purchased at price P at price P and sold at a price P at time 0 and sold at price Q at time 1. Typical, we could have the times could refer to years or just periods. It doesn't matter what we want. Okay. Now, then our expected rate of return would be the following. Would equal Q R minus P over P, over our initial investment. So it's, if you like, it's the profit over the initial investment here. Okay. So according to the CAPM, equation, what do we get here? Now we get R bar I equals RF plus beta I, if you like, times RM, R bar M, minus RF. It's going to be beta I here. Okay. Or now we know R bar I is going to be, so we get Q bar, the expected value of the price we're going to get when we sell it, over P, minus 1 equals RF plus beta I, R bar M, minus our risk-free rate. Okay. So we get that Q bar over P equals RF plus beta I RM bar minus RF. Okay. Plus 1. Okay. Now what do? Then we say that Q bar equals what? Equals P times all of this. 1 plus RF plus beta I times R bar M minus RF. Okay. Or what do we get here? So P, the price we should pay for this asset is what? Now let's just simply solve for P. P equals Q bar over this whole thing. 1 plus RF plus beta I times R bar M minus RF, the risk-free rate. Okay. And here, what is this? This is the price that we should pay for asset I. So this is a fair price to pay for asset I, right here. Of course, we have to know the expected amount that we're going to sell it for, the Q bar. So this is the pricing. This is the pricing form of the CAPM here. Let's see. Remember, our CAPM equation gives us the expected rate of return of any asset, but it doesn't tell us how much we should pay for that asset. Okay. Now, there's also a certainty equivalent form, but let's not do that. It's not necessary. Now, let's look at the following. We'll say that prices must be linear, else, if they're not linear, there are exist arbitrage opportunities. And arbitrage is simply making a risk-free profit. Sometimes we call it an immediate risk-free profit. Okay, let's take an example. Let's take an example of arbitrage. I think we gave an example before, but let's look at an example in currency trading. Okay, now suppose that we could buy euros for $1.25 per euro. Okay? Actually, the euro today is, yesterday it was at 133. Today it's a little lower. And then turn around and sell them at 1.5 dollars per euro. So the people would have to pay us $1.50 per euro. Okay. Now, this is somewhat like currency exchanges do. They buy for a certain rate from you and sell for another rate to you for euros. So they make money on either side of this. In fact, currency exchanges can make a lot of money because they don't give you good rates. The rates are poor usually, and then a lot of times you have commissions on top of that. Okay. Then for $1,000, let's do this. Then for $1,250, we US dollars can buy and purchase 1,000 euros. Okay. Which we can sell for $1,500. $100. Therefore, we made $250 on this exchange. Now, it's very hard to make money on on currency arbitrage because the computer programs are always looking for this. But the currency exchanges obviously make money because they buy at below the market rate and sell at above the market rate. Now, when you see say in the Wall Street Journal or the New York Times, they usually give you a list for sometime during the week of monetary exchange rates. Now, if you look, there's usually a footnote there that says that these exchange rates are for $100,000 minimum. So when you look at those, you never can really get that rate. Okay, now, let's get back to linear prices. Okay, suppose we have two assets. Two assets. These could be physical things, and we call them 1 and 2. 2. That can be bought separately. Either separately or combined. So this is some kind of physical asset that we can combine, like it could be something like take chromium and steel. If you put them together in a certain combination, you get stainless steel. Or you could sell them apart. Okay. If prices are linear, then the price of 1 plus 2, when we get the stainless steel, should equal the price of 1 plus the price of 2. Here we're just assuming that 1 plus 2 is a combination of 50% 1 and 50% 2. Okay. Whereas if you're talking about stainless steel, you only need a little bit of chrome in stainless steel. Okay. Now, however, if prices are not linear, why don't we write this down? This is, let's say, assuming 1 plus 2 is made up of 50% 1 and 50% 2. Okay. Now, but if prices are not linear, and we'll say we have the following, say that the price of 1 plus 2 plus 2 is greater than the price of 1 plus the price of 2. 2. Then we could make an unlimited, of course it would be limited by the market, limited amount of dollars by simply buying 1 and buying 2 and then combining them. To sell as 1 plus 2. Okay. So if the price of 1 plus 2 is greater than the price of 1, the unit price of 1 plus the unit price of 2, then we can make an unlimited amount of money by simply buying 1 and then buying 2 and then combining them and selling them at that. So this would be an arbitrage opportunity. And typically in models and finance, we make the no arbitrage assumption. Now, I was talking about hedge funds before. One of the strategies of hedge funds is an arbitrage strategy. In other words, they take two assets whose prices typically move together, and then they watch the prices of each of these assets. And if they move out of lockstep, then they buy, they have a buying opportunity. So they're looking at mispriced assets, and typically they take them in pairs. So there exist arbitrage opportunities out there. Not very much in currency, because they would be closed immediately as soon as somebody noticed it. Okay. Now, let's look at factor models. Okay. Now, suppose we have n risky assets. N risky assets. I equal 1 to n. It's a typical thing we're doing here. And the rate of return on asset I is given by the following. Ri equals AI plus BI F plus EI. Okay, now this is the equation 8.1. Page 198 of our text. Okay. Now let's look at what these things are. AI is just the y-intercept. Okay. F is our factor. BI is a constant. And it's called a factor loading. Okay. And EI is an asset-related error. Error term. Okay, so what are we going to do here? Now, these factors can be internal, like, for example, book to market ratio. What's the book value of the company, which would equal assets minus liabilities. So that's the book value of the company over the market capitalization. The market capitalization is just the total value of the stocks outstanding in that market here. Now, let's look at some assumptions here on these factor models. Okay, and this is a single factor model. Here, okay. We're going to say, firstly, that we'll say that the expected value of the error equals 0. Okay. So the errors are plus and minus, and in expected values, they cancel out. It'll be 0. 2, we'll say the errors are uncorrelated with the factor and each other. So the error of I and the error of J are not correlated. Okay. That is, we have the following. That the expected value of F minus F bar, the expected value of F times EI equals 0, I equal 1 to n. Okay, so the errors are uncorrelated with the factor, and we said they were also uncorrelated with each other. So we have EI times EJ equals 0 for all I not equal to J. Okay. Now, using these, we can show the following. We can show the following. First of all, we have R bar I equals AI plus BI F bar. And we'll call this equation 8.2a. We also have that sigma I squared, the variance, equals bi squared sigma f squared plus sigma squared EI. Now we said the expected value of the error was 0, but the variance doesn't have to be 0 here. We're squaring it. And this is 8 to b. And then we have the covariance, sigma ij, equals bi bj, bj, sigma squared f. Let's call that f here. Okay. I not equal to j. And we'll call this 8.2c. And all these are on page 199. And finally, we get that bi equals the covariance of ri and f. Okay. With a risk-free rate over sigma f squared. Now notice this is 8.2d. Notice that this is somewhere to equation for beta I in the cap M. And in fact, the cap M is a single factor model. Okay. So it says that cap M is a single factor model. And that factor is how is the market doing? Typically when the market is going up, most stocks go up. We could also have exogenous factors like we could look at the gross domestic product. Okay. Okay, then there is a topic called arbitrage pricing theory. Or APT, which was developed by Ross. And arbitrage pricing theory gets us about the same results as we get for factor models here. Okay, but it's a bunch of algebra to develop the equations for that. Let's skip over that, okay? Actually, I see here in my notes it goes on and on. Okay. Now, let's move into another topic. here. We're moving pretty fast today. Let's talk about utility theory. And utility theory is, of course, an important topic here. And it's not just for investments, it's an important topic in a lot of fields. Okay. I must be missing a page here. Let's see something. Here we go. Oh, good. Oh, okay. Now, let's note first that utility theory what do we say? The utility theory approach to portfolio selection is consistent with the mean variance approach if we have either of the following. Either one, okay, a quadratic utility function and we'll see what this is in a little bit. Or two, the rates of return okay, these are random variables are normally distributed. Okay. Now, let's look at a numerical example. It's a nice example. Of utility theory. And risk aversion. Okay. And this example will be quite simple. We're going to do the following. Let's assume we have two lotteries that we could play. You could think of these as two games that we could play. And we'll call this, let's call it lottery 1 and 2, and outcome A and B. Okay. Now we could think of this as a coin toss. So the outcomes would be either head or tail, and they would each occur with probability 1/2. Okay? each are equally likely. So in lottery 1, what happens? If we could call this guy, if you want, we could call this guy a head, and this guy a tail, if you like. That's an easier way to look at this, in fact. In lottery 1, if we choose lottery 1 and we get a head, we win $10,000. However, if we get a tail and we choose lottery 1, we lose $5,000. Okay. Whereas in lottery 2, what happens? If we get a head, then we win less money. We win $4,000. But if we get a tail, instead of losing, we just end up with nothing here. Okay. And we have PA, probability A equal probability B equal 1/2. Of course, we have a coin toss here. Okay. Now, most people, decision makers, we'll call these DMs, will prefer lottery 2 to lottery 1, even though we have that the expected value of lottery 2 this should be 16. The expected value of lottery 2 is equal to what? Is equal to 1/2 times 4,000 plus 1/2 times 0 equals $2,000. And this is less, strictly less, than the expected value of lottery 2. Expected value of lottery 1, what should I say here? Yes. Expected value of lottery 1. Expected value of lottery 1 is what? Equals 1/2 $10,000 plus 1/2 minus $5,000. Okay, equals $2,500. So the expected value of lottery 1 is strictly greater than the expected value of lottery 2. But most people would pick lottery 2. Why? Most people are risk averse. So they say, you know, I'd rather take lottery 1 even though, lottery 2, even though it has an expected value less than lottery 1. Because in lottery 1, I have a 50% chance of losing $5,000. Whereas in lottery 2, I have no chance of losing any money. I can either make $4,000 or make nothing. So people are risk averse. And let's see this. Let's, let's derive a utility theory, utility function for this situation. Okay, and also and a decision maker. Okay. Now, to derive a utility function, we're going to use the following. We will use the following. Following axiom, and this is a continuity axiom of utility theory. Now, if you look in different books, you'll see a number of different axioms given to develop utility theory. We're going to use very simple. We're going to use one that has 3 axioms. We'll give them in a second. Okay. And our axiom is going to be the following. We'll say that if we have 3 outcomes, we'll call them A prime is preferred to B prime is preferred to C prime, then there exists and sometimes we use this symbol like this for there exists a probability P for outcome A prime such that the decision maker is indifferent to a choice between the lottery let's give the lottery here, and typically graphically we do a lottery like the following. We say L and we go 2 things. So let's put a probability on each of our legs here, and we'll say A prime, C prime. So you're indifferent to a choice between the lottery that gives you the best outcome with A prime and the worst outcome with 1 minus P prime. Okay? And receiving B prime with certainty. Okay. So B prime, you could say that B prime is the fair price for this lottery here. Okay? Also, for this you have, well, let's continue on the next time. Thank you. Okay, good.